Assalamu alaikum. In this video, we will discuss alternative concepts of consolidated financial statements. We will discuss parent company concept and economic entity concept. We will identify the differences between the two concepts that are centered on conflicting views based upon non-controlling interest, consolidated net income, and consolidated balance sheet values. Finally, a related issue on elimination of unrealized intercompany profit in the determination of consolidated balances will be discussed. But before I start the discussion, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories, without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use her time in making these video. Let us start with the discussion on the parent company concept and economic entity concept. Business combination can be done either by asset acquisition or stock acquisition. If business combination takes place by asset acquisition, then the books of the acquired company are closed, as 100% of the business will be acquired by this method. In case of stock acquisition, both the companies, acquiring company and acquired company, exist and they will prepare their financial statements separately. However, periodically the acquiring company will combine the two sets of books together through consolidating process, and these statements are called consolidated financial statements. The technical procedures will be explained later in the videos to follow, but in this video we will talk about the theoretical concepts involved in accounting for consolidation. FASB Accounting Standards Codification number topics 805 and 810 state that the economic entity concept is embraced more fully than parent company concept. A third concept, proportionate consolidation, although never used, was advocated by few in the past. The proprietary interest is divided between the controlling interest, stockholders of the parent company, and non-controlling interest, interest of those shareholders that are not part of the parent company shareholders. Let us now talk about parent company concept and economic entity concept. Parent company concept emphasizes on the parent company shareholders. So the consolidated financial statements, that is consolidated income statement and the consolidated balance sheet, are prepared to make the parent company financial statements more informative about the parent's total ownership. Economic entity concept represents the affiliated companies as a separate, identifiable economic entity. This helps in making a meaningful evaluation of financial position and results of operations of the parent company and its affiliates. The economic entity concept emphasizes control of the whole as a single management. Thus, the consolidated financial statements provide information about two groups of legal entities, a parent company and its subsidiaries operating as a single unit. The primary purpose of parent company concept is to prepare consolidated financial statements relevant to the controlling stockholders, while the non-controlling interest is presented as a separate component before stockholders' equity in the consolidated financial statements. However, the economic entity concept treats both controlling and non-controlling in stockholders as contributors to the economic unit's capital. Thus, the non-controlling or minority interest is presented as a component of equity in the consolidated financial statement. The conflict between the parent company concept and economic entity concept are centered on four aspects. Let us look into each one of them. First, the non-controlling interest. Under parent company concept, the classification of non-controlling interest is not clear, as this concept views the consolidated financial statements as those of the parent company. It treats the non-controlling interest as a liability, but the parent company do not have any obligation to pay off such liabilities. Nor it is treated as a component of owner's equity, as the non-controlling investor do not have any ownership interest in the subsidiary's parent. Perhaps that is the reason that non-controlling interest is reported below the liabilities but above the equity in the consolidated balance sheet. Under the economic entity concept, a non-controlling interest is a part of the ownership equity in the entire economic unit. Thus, a non-controlling interest is equated to the controlling interest, that is, as a component of owner's equity. Let us now talk about what income figure constitutes consolidated net income. Under the parent company concept, the consolidated net income is determined after deducting the non-controlling interest income as an expense. This is done as the primary purpose of parent company concept is to prepare consolidated financial statements relevant to the controlling stockholders, that is the parent company shareholders. Since the economic entity concept view the consolidated financial statements as those of a single economic entity, where it classifies the stockholders' interest as controlling and non-controlling interest, the consolidated net income combines the income of the parent company and its subsidiaries. After that, the income is allocated to the controlling interest and non-controlling interest proportionately. The non-controlling interest in net income reflects the share of the consolidated net income allocated to the non-controlling stockholders. Thus, the non-controlling interest in net assets is considered as a separate element of stockholders' equity. Let us now talk about consolidated balance sheet values. The acquiring company can acquire less than 100% of the subsidiary through stock acquisition. The question arises, how to value the subsidiary assets and liabilities? One way is to determine total fair value implied by the price paid for the controlling interest, or adjust the book value only for the portion paid by the parent company. Let us talk more about it with the help of a illustration. P company acquires 75% in S company for 1,500,000. The book value of net assets of S company is 1,600,000. The implied fair value of the net assets of S company will be 200,000, that is 1,500,000 divided by 75%, and this will be equal to 200,000. and the difference between the implied fair value and the book value will be 2 million minus 1.6 million, and that is equal to 400,000. The question is, should we write up the net assets of S company for 400,000 or for 75% of 400,000? A write-up is an increase made to the book value of an asset because its carrying value is less than the fair market value. A write-up generally occurs if a company is being acquired and its assets and liabilities are restated to fair market value under the purchase method of merger and acquisition accounting. Let us see how the net assets of S company be written up under the parent company concept and economic entity concept. The write-up in the case of a parent company will be 75% times the difference between the implied fair value and the book value we have calculated in the previous slide, that is 400,000. So this will be equal to 300,000. In case of economic entity concept, the write-up will be the difference between the fair value, that was 2 million minus 1,600,000. So this is equal to 400,000. So you see, that's how the difference is between the parent company concept and the economic entity concept. Theoretically, write-up should be restricted to the amount actually paid by P company in excess of the book value of the interest it acquires. In our example, P company acquires 75%. So P acquires 75% of 1,500,000. So the excess paid by P company is 1,500,000 minus 75% of 1,600,000, and this will be equal to 300,000. Sorry. On the theory, the consolidated financial statement should reflect 100% of the net assets value of the affiliated companies. Let us now talk about how to record net assets of the subsidiary in the consolidated financial statement. Now, in the case of parent company, we will take the book value, and the book value is 1,600,000 plus parent's share of the difference between fair value and the book value, and we have calculated it as 300,000, and this will be equal to 1,900,000. On the date of acquisition, the net assets of the subsidiary are included in the consolidated financial statement at their book value, that is 1,600,000, plus the entire difference between their fair value and the book value, and that is what we have calculated as 400,000. So this is equal to a total of 2 million. In case of parent company, the non-controlling interest is reported as its percentage interest in the reported book value of the net assets of S company. Now, parent company has acquired 75%, so the non-controlling interest is 25% of 1,600,000, and this is equal to 400,000. While the non-controlling interest in case of economic entity concept will be reported at its percentage interest in the fair value and not book value of the net assets of S company, that is 25% times 2 million, and this is equal to 500,000. Now, regardless of the concept followed, whether it is parent company or economic entity concept, the controlling interest in the net assets of the subsidiary reported in the consolidated financial statement will be the same, and it will be equal to P company's cost, and this can be seen over here. Now, the net assets of S company included in consolidation is 1,900,000. In the case of economic entity concept, it was 2 million. The non-controlling interest in the case of parent company was 400,000, and in the case of economic entity concept it was 500,000. So the controlling interest here is 1,500,000, and here also it is 1,500,000. So that's how we get the same value for the controlling interest. And finally, let us talk about intercompany profit. Regarding intercompany profit, there are two alternative points of view: total 100% elimination or partial elimination. Under total elimination, the entire amount of unconfirmed intercompany profit is eliminated from combined income and the related asset balance. Under partial elimination, only the parent company's share of the unconfirmed intercompany profit is eliminated. We will elaborate more about it in the videos to follow. So this completes this session on alternative concepts of consolidated financial statements. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning. Thank you so much.